Welcome to this explainer. Today, we're peeling back the layers on single-stock inverse ETFs and exposing the hidden mathematical realities behind them. If you've ever looked at a massive company and thought, man, I really want to bet against that stock, you've probably stumbled across these financial products. They look incredibly straightforward on the surface, but underneath, well, they're driven by complex machinery that can catch even seasoned investors completely off guard. Today, we are laser-focused on the precise risks behind 1x ETFs.
Here's our roadmap for this explainer. We're hitting 1. Betting against Apple stock. 2. Inside the bear ETF. 3. The daily rebalancing mechanism. 4. The compounding math trap. 5. Beware of volatility drag. And finally, 6. Read the warning label.
All right, let's jump right into Section 1, Betting Against Apple Stock, the surface level. We're beginning our investigation with a very specific, real-world instrument, the Direction Daily AAPL Bear 1X ETF, commonly known by its ticker symbol, AAPD. Just look at this massive historical drop. If you happen to hold AAPD over the past year, your total return was a brutal negative 37.05%. And since it launched back in August 2022, the average annual return has been hovering right around negative 17.39%. I mean, those are some heavy losses. But to understand exactly why that happened, we really need to look at what this fund is actually designed to do.
So the crucial point is right here in the definition. A 1x bear ETF provides inverse or negative 1 times exposure to the daily price movement of a single underlying stock. Now, investors often buy this thinking, hey, this is just a simple, straightforward bet that Apple stock is going to go down. But the reality is much more complex. And that word daily right there, that is the absolute key that unlocks this entire puzzle.
Moving on to Section 2, Inside the Bear ETF, Popping the Hood.
Because if you think buying AAPD just means you're shorting a bunch of Apple shares in a standard brokerage account, well, you are in for a surprise. Check out these top holdings. This brilliantly illustrates what's actually going on under the hood. The ETF is holding massive amounts of Treasury cash management funds like Dreyfus Government Cash at nearly 71% and Goldman Treasury Institutional at almost 24%. And alongside this literal mountain of cash, they hold specialized derivative contracts called Apple Inc. swaps at negative weights. So they're using these swaps with major counterparties to achieve that exact daily inverse return. You're actually investing in a highly complex structure of cash and derivatives, not just shorted stock.
And you know what? You're paying a premium for all this machinery. The gross expense ratio for AAPD is 0.96%. Maintaining those swap contracts, actively managing the cash, and constantly adjusting the exposure, it all takes real work. And those fees act as an immediate headwind on your potential returns before the opening bell even rings.
Which brings us to Section 3, the daily rebalancing mechanism, the core engine.
To really grasp the risk here, we absolutely have to look at the mechanism keeping this ETF on its negative 1x target, because this is where the greatest long-term dangers lie. Here is exactly how it works step by step every single day. 1. The trading day ends. 2. If Apple's stock gained that day, the ETF actually has to increase its inverse exposure to make sure it accurately targets a negative 1x return for tomorrow's newly sized asset base. And 3. If the stock lost value, the ETF has to reduce its exposure to prevent becoming over-leveraged. What this means for you is that your performance depends entirely on the specific day-to-day path the stock takes, not just where the price ends up months down the line.
Let's dig deeper into that in Section 4, the compounding math trap, amplification. Now we hit the absolute core of our explainer, how this daily rebalancing creates a phenomenon that fundamentally alters your expected returns over time. Looking at these examples of NVIDIA and Tesla provided by leverage shares, you can literally see how continuous daily gains or continuous daily drops totally distort returns. Now, while these specific tables show a 2x leveraged ETF, the exact same mathematical principle applies perfectly to our 1x inverse scenario. If a stock moves consistently in one direction, let's say gaining 2% every single day for 10 days straight, the compounding effect actually amplifies the leveraged return beyond a simple multiplier. But the reverse is also true. A continuous drop applies to a smaller base each day. Take a second to really digest this. The expected return completely decouples from simple math.
Because compounding builds on previous daily returns, it amplifies gains in a steady trend, but severely distorts expected results over time. The underlying math means each day's return applies to a newly adjusted base. Let's think about it this way. Say you invest $100. If it drops 10% on day 1, you've got $90. A 10% gain the next day is a gain on $90, not your original $100.
So you only gain $9, leaving you at exactly $99. You are literally losing money even though the percentage moves seem to just cancel each other out. This completely changes the game for your long-term expectations.
So what happens when a stock doesn't trend steadily up or down, but just bounces around? Let's look at Section 5. Beware of volatility drag, the value destroyer. This chart tracking an oscillating Palantir stock is the ultimate gotcha moment. It visually proves that choppy markets destroy ETF value. In this scenario, the stock is basically alternating between a 2% gain one day and a 2% loss the very next day, just bouncing back and forth for 10 days. The ETF is doing its job perfectly, diligently tracking its daily target, but look at that trajectory. The constant resetting creates a relentless downward pull on the total value. The compounding effect in a sideways, choppy market works aggressively against the investor.
The numbers here are striking. Even though a simple calculation suggests the underlying stock would see a tiny expected loss of 0.2% over those 10 days, and a standard multiplier would assume a 0.4% loss, the actual compounded ETF loss is 0.8%. It's literally twice as bad, simply because the market was choppy. This is what we call volatility drag, and it quietly, relentlessly erodes your capital every single day the stock just moves sideways.
Which leads us to our final part, Section 6. Read the warning label, the issuer's own words.
Because of this highly destructive mathematics, the fund issuers themselves are incredibly upfront about the dangers. Let's look at Direxion's own words regarding AAPD. They explicitly state, the funds will lose money if the underlying stock's performance is flat over a period longer than a single day. I mean, let that sink in for a second. They are directly warning you that a flat market will actively erode your money. Furthermore, they note that it's entirely possible the bear fund will lose money even if the underlying stock's performance actually decreases over a period longer than a single day. You could be 100% right about Apple going down and you could still lose money. Wild, right?
Educational materials from Levers Shares back this up, pointing out that these tools are strictly for short-term, active monitoring. They state, the fund is not intended to be used by and is not appropriate for investors who do not intend to actively monitor and manage their portfolios. Plain and simple. These are highly tactical tools meant for day traders. They are absolutely not for buy and hold investors waiting around for a long-term thesis to play out.
So, as we wrap up this explainer, I want to leave you with this crucial question to ponder. Is the convenience of just clicking buy on a single stock bear ETF actually worth the hidden mathematical risks of compounding, daily rebalancing, and volatility drag? Understanding this underlying machinery is really the only way to ensure your portfolio doesn't fall victim to the silent, invisible erosion of the daily reset. Thanks so much for learning with me today, and I'll catch you next time.